the scene. He's got the voice that's mean, asking those questions that you never seen. He's got that fire, burning bright and clean. Andrew Keen making waves, break the routine on the Keen on show. He brings the heat, asking the minds, digging deep till they bleed. No sugar-coated truths, no lies to deceive. Andrew Keen, the master of the interview beat. He's got the knowledge, he's got the flair, challenging ideas with a fearless stare. With every question, he's uncovering what's there. Andrew Keen, a truth seeker, he's aware.
Hello, everybody. As we speak, it may be different by the time you actually watch this. The Dow Jones is almost at 40,000, which means we're all rich because we all are invested in mutual funds, ETFs, and all sorts of other complicated financial instruments that I don't understand. However, our guest today is less sanguine, more pessimistic in some ways. What goes up? Does the rise of index fund catastrophe? Is the cover story of this month's Harper's Magazine, and its author, Andrew Lipstein, is joining us from Brooklyn, just outside New York. Andrew, are we on the verge of catastrophe?
On the verge, I hope not. The purpose of the piece is not to make people immediately withdraw all their money, but it is to make them think a bit more deeply about the assumptions we have about the market and the assumptions behind their investments, assuming they're like most Americans and sort of have their money parked in some of the biggest public companies.
So explain what you're trying to explain in this piece. Most people just take it for granted that their 401ks, their mutual funds, their passive investing is safe. You're suggesting that that may not be the case.
Yeah, with the piece, I think even introducing the concept of index funds to the average reader and to have them just consciously think about what an index fund is and what passive investing is going to give them sort of more agency and more maybe introspection on their investment strategy than I've had before. I'm in no way being condescending. As I say in the piece, the bulk of my family's savings is in passive investing. It's just sort of an automatic thing that people do now. And I think it's troubling and worth inspecting when the public is doing something automatic with their money, because there is no such thing as a permanent paradigm in finance. And it's very important to remember that we're always currently in a paradigm. And so I wanted to examine how we got here, what it means that we're invested so heavily in index funds. And then by talking specifically to Michael Green, who is, one of the most famous index funds doomsayers, think about what could happen in the future, not tomorrow, not next year, but in the next few decades.
Yeah, and some viewers and listeners will know Michael Green as @ProfPlum99 on X. So before we get to what we should be worried about, Andrew, explain the current investment economy, the thing that you're describing, because when I read the piece, and you're a successful novelist, so this is a beautifully written piece. Many of our viewers will know you from your book, The Vegan from 2023 and Last Resort from 2022. I know you're working on a new novel, Something Rotten, that will be out next year. So this is finance written by a novelist. You make it very clear, but what are you trying to make clear? What is the situation? We all put our money into these 401k plans, and you're suggesting that potentially that, if not unwise thing to do, that might be the foundations, if that's the right word, or the lack of foundations of the next great crash.
Yeah, so it's really, I think, important to think about very basic definition of what a price is for a specific stock, and then for a total index fund, which is of course made up of stocks and in some cases bonds. The price of a stock is what the investing public thinks that stock should be worth in total. So you just multiply the number of shares out there by the price, and you get what's called the market cap, or how much the public deems this stock is worth. This is sort of a basic tenet of economics and market philosophy. And we say that a market is efficient when the price of any given stock reflects all available information. This is sort of like taken for granted for what a stock market is, for what publicly traded assets are. What passive investing has purported to do from its beginning is simply measure the market in whole. So through index funds, you could basically say, I want to not invest in one particular stock. I know I should diversify. I just want to invest in the market in total. And so what a basic index fund will do, and some listeners might be more familiar with like SPY or VOO, which both measure the S&P 500 of the biggest companies. What those do is you can just put basically as little as $1 in that fund, and it instantly splits your money into these companies basically by how big they are.
So this is like in the piece you talk about State Street's SPDR. These are okay.
Yeah, so SPY is run by State Street, and BlackRock, Vanguard, and State Street are known as the big three sort of index fund managers or investment firms or asset managers or institutional investors, depending on who you're talking to. But basically, passive investing index funds, they say their reason to exist is to measure the market, to capture it. And they're not the ones who are setting the price. There are other people who are looking into either a company's fundamentals, there's a shift in their corporate management, there's a new investment opportunity, there's a new market opening, or there's a lawsuit that's catching up to the company. There are active investors who are the ones who are deciding the price, and passive investors are merely using that price to invest. But what we've seen, especially in the past 20 years, is passive investing getting so popular that we're getting to the point where it's uncontestable, unimpeachable to say that they are having an effect on the market. Passive investing, since actually earlier this year, is now bigger than active investing as far as the.
What are the numbers, Andrew? You spell them out in the piece.
Yeah, I mean, I could look it up in the piece, and I don't want to state a number now and for it to be incorrect.
Well, I'm quoting from the piece. You say that passive investing is now estimated to account for more than $15 trillion globally, which is a lot of money.
Mm-hmm. Yeah, it is a lot of money. And it's a lot of money that you could think about in total, 15 trillion. You could also just think about your neighbor, your friend, yourself, your parents, where they have invested their money and how much of that is in index funds. And if you really think about it, I think, could be considered insane how much money we have invested in something that we don't actually have any stake in. And I can go into this in a bit, but that disconnect between putting our dollar to something and not actually caring about the thing we're putting it to, I think could be at the basis of what is distorting the market. But
distorting the market, you mean it's too high at 40,000 or near 40,000? This exuberance is feeding on itself. Are you suggesting that the problem is a psychological one rather than an economic one? Everyone puts their money into mutual funds because it's benefited through our 401ks. We save taxes, which drives up the stock market. But then are you suggesting that there's no real reason for the rise in the stock market apart from the fact that we put our money into mutual funds because that means we don't have to pay taxes on them? Yeah,
well, first of all, mutual funds can be active or passive. Second of all, I'm not saying that the prices right now are solely dictated by passive investing. If that were the case, then it wouldn't matter if Facebook announced poor earnings or something like that. Active investors still do define the price. The difference between an active investor and a passive investor is an active investor will be looking at fundamentals and deciding the price. A passive investor really only has one input to whether they will invest more or less, and that's whether people who invest in passive funds have money left over. So what we've seen, especially in the past 20 years, is that retirement funds have only increased. So on the passive side, that has only increased to more demand for a stock than people who are selling. So the question is, what happens when that changes? People say the stock market has only gone up, the country's GDP has only gone up, our economy has only gone up. The number of people who need to have money to invest has only gone up. Taking all those assumptions for granted is extremely dangerous, because if passive gets big enough and those things change, then what we'd see is a hugely depressing factor on the market, which could invoke volatility because of the nature of passive investing. And I go into this in the piece, but passive investing is different from active investing sort of on a molecular level for a few reasons. First of all, passive investing is much more inelastic. and that creates a much more inelastic market. And that's because people who invest in passive funds sort of add to the bulk of that market, but don't decide the price on the margin. So they aren't impacting the price. And the more money is in something, but the less people who are deciding what that money does will result in a more volatile market. And this is something that Michael Green, who I sort of profile in the piece, has actually made a lot of money on. Specifically, he made a big bet on behalf of Peter Thiel's family office that resulted in trade worth nearly $250 million. He theorized that only a 4% movement in the market would result in a much larger shockwave of volatility, and he was exactly right during an event in February of 2018 called Volmageddon. And besides inelasticity, another factor of passive markets that can be extremely disconcerting is correlation. When stocks are correlated to each other in a healthy market, if something
everyone's attached. So if one person falls, then
Exactly.
everyone falls.
Exactly.
Could you and excuse my ignorance here, Andrew, my financial ignorance. When I was reading this, I'm not sure whether I'm a passive or an active investor. If I, like everybody else, I have a 401k and other retirement funds. They're managed by big firm Merrill Lynch.
Mm-hmm.
Does that make me a passive or an active investor? I don't really know. Does that mean that I have to look at the exact funds that my money's in? Or is the fact that I'm giving my money to somebody like Merrill Lynch, does that make me by definition a passive investor?
Yeah, you'd have to give me your Merrill Lynch login credentials, and I can quickly.
Now I know what your business model is, Andrew.
Yeah. So the short answer is they are probably considered an active investor on behalf of you, but they're probably investing in passive vehicles. I'm willing to bet that index funds are a huge part of how they actually invest for you, but they probably tell you on calls you have with them once a year or prospectuses they mail out that they're.
Yeah, when I get on calls with them, which I try to avoid, I never listen to what the guy says. Although you have a wonderful, which I'm gonna, you have one great. Let me see if I can find it in the piece about when you were talking to one of the Vanguard people about something who's a classic fund, and then you talked about him. What is it? Sweating into his. You remember that?
Well, I did say that I think.
Let me quote it. He says he's affable, patient, and optimistic. He says things like, "We really are the place for the little guy," and I love index investing. But you make some fun of him. But coming back to sorry, go on.
No, I didn't. I don't want to say I made fun of him, and also I'd never said that he sweated. I think you're thinking of. I said the word correlation has the power to make money managers sweat straight through their fleece vests.
Yeah, well, I like that. I'm going to send that to mine, and he'll probably sue you.
Okay, well, at least as long as there's a lawsuit that comes out of this, I'm happy.
Yeah, because my wife's a lawyer, so she can represent you.
So that's your long game, I see. Okay.
Yeah, well, we've all got a game, Andrew, as you know, in the piece. But in all seriousness, is the difference then between passive and active investing that whoever's putting the money in, whether it's a fund or a manager or an individual, they're looking at the stock, a Facebook, for example, whereas an index fund is sort of, is it algorithmic investing in sectors or groups, which doesn't actually look at the stock? Is that the way to distinguish between?
Yeah, it's way more rudimentary than the word algorithmic would imply. It is just an index fund is just a grouping mechanism for which stocks are considered included in that. And the most rudimentary is going to be one that just measures the biggest stocks. Of course, you have index funds that measure that include a specific industry. Like, let's say you want to invest in copper, but you want to sort of diversify within the copper industry. You can find an ETF that just measures copper. If you're giving your money to Merrill Lynch and they, for some reason, think that copper is on the rise and they choose to invest in copper until they think it gets too expensive, then they're really using index funds for active investing. But that's really not how index funds are, just by their bulk, are being used in the market.
You mention, as always in these sorts of pieces, the Dutch tulip mania of the 17th century. But is there any equivalence? The point about the tulip mania, it was an economic euphoria built on something that has no value.
Mm-hmm.
This thing that you're warning about is built on the strength or perhaps the weakness of the US economy. No one's putting money into Bitcoin. This is not some sort of scam, is it?
Yeah, so I think what's truly fascinating about calling passive investing a bubble is that it really bucks every association we have about bubbles. We associate them with greed. We associate them with, as you say, attaching value to something that doesn't really have value. But I would argue that it's really about attaching way too much value to something, whether or not it has actual value. But we really don't allow for this term bubble to encompass something that is actually at its core deemed to be healthy and responsible and safe. I mean, in the piece, I talk about this theory that's often misattributed solely to a guy named Hyman P. Minsky, an economist, but is actually, as I say in the piece, more of an intellectual baton passing. And he lists 5 stages for the bubble. And we've seen the first 2, displacement and boom. And where, of course, we can't match passive investing to his 5 stages, the next stage, which is euphoria, because there's no such thing as euphoric passive investing. The very definition of passive investing is that you don't have strong emotions attached to it. You're just doing it because it's safe. But that could be its biggest fatal flaw, is that it attracts so much money because people know they have to invest, but they don't want to be hubristic. They want to lower their risk as much as possible. So they choose an investment they think doesn't have risk. But the very definition of any sort of investing is that it always comes with a fair amount of risk.
Well, I hope we've made people very nervous, because Andrew is certainly making me nervous. I'm thinking of taking my money out and spending it on his books. We are speaking with Andrew Lipstein, the author of What Goes Up, the cover story, no less, of the June issue of Harper's excellent magazine. And I want to thank, as we're speaking of excellent magazines, the Quarterly Liberties, which are helping us bring great guests like Andrew Lipstein. It's a quarterly of culture and politics to be read with Harper's, similar writers, similar themes. Going to run a short feature on liberties, and then we'll be back with Andrew. And I want specifically to talk about this character, Michael Green. He drove from New York to Philadelphia to talk to him early in the morning, and it's a wonderful narrative. So we'll be back in a second. Don't go away, anyone.
The noise, there is nuance, insight. Liberties is not just a journal of ideas. It's a meteor of intelligent substance. It's the place to be for engaged citizens. Politics, opinion, substance. Liberties is a triumph for freedom of thought. A quarterly of urgency, of cultural exploration, of intellectual delight, of immaculate prose. It's invaluable. Subscribe now or find Liberties at your favorite bookseller.
And you can subscribe to Liberties at libertiesjournal.com. We're speaking with Andrew Lipstein, one of Brooklyn's great, I would call you a young writer. You're a young novelist, Andrew. I hope you won't take that as an insult. I know you've got young children. Also the author of a fascinating, very provocative cover piece for Harper's this month. What Goes Up? Does the rise of index funds spell catastrophe? Perhaps the best known index fund skeptic, if that's the best description, is a man called Michael Green. Some of you will know him on X at @AsProfPlum99. Andrew drove from his home in Brooklyn to Philadelphia to talk to him. That begins the piece. Tell us about this guy and your journey, Andrew.
Yeah, so I went to speak with Michael Green basically because I wanted to find someone who had the strongest point of view, both the most public and someone who is sort of unwavering in his skepticism. Because in the piece, I also wanted to balance him out with people who are less skeptical or even pro-passive investing. But I drove to Philadelphia to speak with Michael Green, and basically,
of all places, you note that it's an appropriate place. What's so appropriate about Philadelphia?
finance is obviously obsessed with the market, but he also owes a lot of the bulk of passive investing to recent regulation. He believes that the government is heavily invested, excuse the pun, in keeping people invested in the market, and in doing so through the 401k vehicle, which has sort of emerged in a blip of legislation more than 50 years ago, but has since become the way that the government tells its citizens they'll have money for them when they retire. But yeah, I mean, Michael Green is a super fascinating person. He has both managed Peter Thiel's family office and a fund seeded by George Soros. I don't know if you could find a single other individual on the earth who's worked with both of those men, for reasons I think will be obvious to your well-educated listeners. But yeah, I basically wanted to visit him to basically scare the crap out of myself, and he successfully did that. He sat down with me for 4 or 5 hours and just spoke to me nonstop. I think he could have gone 30 hours after that about how he sees the market, what he thinks is wrong with it, his own history. He's someone who is both extremely knowledgeable and extremely opinionated. And when I left him, I was sort of in a daze of trying to take those two threads apart, his knowledge and his opinions, because when you're around someone like him, they can almost be infectious, or you can almost find that their point of view is contagious. And, as I say in the piece, I'm a passive investor. I was very, worried for my money, my family's money, and basically through the rest of the piece, tried to speak to other people and go through the history of index funds to figure out exactly how right or wrong he is.
Yeah, and some of the people who support him, there are some dodgy characters. I mean, I didn't know anything about him, but everybody knows about Cathie Wood, Elon Musk, Robert F. Kennedy. He seems to attract, at least his ideas attract an odd crowd. Is there some truth to that?
Well, I want to be clear that some of the people who are vocal skeptics of passive investing are for reasons that are not entirely aligned with Green. The biggest issue right now, the one that people talk most about, especially in the media, is something called common ownership, where they believe the fact that the big three, Vanguard, BlackRock, State Street, own so much equity in competing stocks is sort of an antitrust problem. If only a few people are managing 30% of both, Coca-Cola and Pepsi, to use the most obvious example, that could be problematic. So I would say common ownership is something that has attracted people like RFK Jr. the most. Now, like people who are more financial, such as Cathie Wood, Michael Burry, who was one of the first people to foresee the 2008 crash, and David Einhorn, are people who are actually concerned with what Michael Green is. Now, skeptics of the skeptics would say that they only hate passive investing because they are active investors. And passive investing has taken a lot of money from active investors. I say in the piece that over the past 20 years, only 7% of active funds have outperformed the market. And that doesn't even take the fees of active management into account. I think a lot of active managers would love for Michael Green to be right, because it would give them more of a reason to exist. I think for the average investor, because the fees of index funds are so low, it's sort of the obvious choice.
Although if there was a crash, what you call a catastrophe with active investing, with passive investing, it would probably bring down the active investors. Wouldn't it result in a stock market crash? I mean, if this happens, in the worst case scenario, what happens? What is he saying?
Yeah, well, you're sort of asking two things there. First of all, active funds, hedge funds, people who have a very conscious point of view often profit from volatility. You saw that in sort of the meme stock mania of 2021, where it was seen as a David versus Goliath situation, and a few hedge funds suffered, but a lot of them made a lot of money off of it. But to answer your second question, like what's the worst that can happen? I think Green's ultimate doomsday scenario is that for a reason of a generational shift or a regulatory reason or just a shift in paradigm, people start putting their money in something else besides passive funds. And at that point, passive being such a big part of the market that their only input being, do people have money to invest, goes down. And then you see, because as previously discussed, the inelasticity and correlation of a passive market, just sort of a sharp decline in the value of public stocks, where sort of everyone is trying to leave as soon as they can.
That doesn't make sense to me, because there's only two things anyone with money well, three things, I guess, you could do with it. Firstly, you put it in stock. Secondly, you put it in real estate. Thirdly, you put it under the bed, maybe in gold.
Mm-hmm.
So you talk about this shift in paradigm. What's going to happen? Everyone suddenly wake up to the fact that passive investing isn't wise. They're not going to all go out and use that money to buy another house or put the money under the bed or invest in gold. They're more likely simply to become active investors, aren't they?
You're telling me that somebody who up to today has 2/3 of their savings invested in the market in total is going to take their money out, and in order to profit off of an event like that, they're going to invest in put options. They're going to write covered calls. They're going to sell call options. They're going to buy derivatives. I don't think that's the case. The average investor isn't equipped to profit from a bear market. Their hope is to stay through a bear market or invest more in a bear market when prices are low and come out the other side better. I mean, buy low, sell high, and don't try to catch a falling knife. And the market only goes up in the long term. These, to me, are the tenets of the average American investor. Those tenets do not supply the necessary knowledge or know-how to take advantage of a market that is only going down or steeply going down. I don't think active investing is right for the average investor, and I certainly don't think that the bulk of the public becoming active investors would help tamp down volatility. If anything, that would increase volatility way more than even someone like Michael Green imagines.
This stuff is very, very complicated, Andrew. You don't need me to tell you this. Most people's head spins when they understand or don't understand the difference between passive and active investing. The markets are controlled by complicated algorithms that almost no humans understand. You're distinguished not as a financial writer, but as a novelist, although your last book, The Vegan, was about the financial markets, last resort. And as I said, you're working on a new novel. Do you think, given the complexity of our financial markets, that novelists like yourself, fiction writers, people skilled in the creation of metaphor, are best suited to writing about the dangers and challenges of our financialized world?
Well, I think if there's anything that we're most at risk of as an investing public, especially in this case, it's a lack of imagination as far as what can happen. And I think if novelists have one thing to trade on, it's imagination about what could happen. Someone like Michael Green is very concerned with what could happen in a specific way. I don't think it's important to be a mouthpiece for his ideas. What I think is important, especially as a novelist, is to think about what could happen and to dislodge any sort of reader about their assumptions about the market or money or investing. Not every novelist is worth listening to on the market. I don't think novelists should be what journalists are. The point of a piece like this is not to say what will happen, but it's basically to give the reader the ability to zoom out a little bit about what they are doing with their money and what could happen, and to challenge their assumptions.
You end, well, before we actually get to the end of your piece, tell us more about this Michael Green character. You spent, as you said, 5 hours with him. You drove from Philadelphia. The way you describe him, you may correct me, sounds a rather scary guy. Walks around with 2 huge dogs. What's he like?
Well, he's not always with the dogs. He's not like a Batman villain. I would say he's an incredibly engaging person. If I were to meet fiance's dad for the first time in a sort of rom-com, he would probably play her dad because he's so sort of intimidating. I think I say in the piece that he sort of resembles Tom Wamsgams from Succession, maybe without sort of the bumbling humor. He's unwavering. He's someone who will, if they speak to you for 5 hours about the market, they'll look you straight in the eyes the entire time. Yeah.
And then tell me about the dog and your interaction with him on his dogs, which was rather amusing.
Yeah, as I say in the piece, and I want to be careful not to say more than I do in the piece, but he wanted to meet at a cafe before we actually talked, so his dogs get used to me. He said one of his dogs was insane, though very sweet. And he sort of alluded to an incident between the dog and two deer, in which the dog may or may not have ended the deer's lives. And that just sort of set the tone for the entire interview, which is, as he speaks to me, I'm wondering, am I going to lose my legs? Am I going to lose all of my savings? He's someone who keeps you on your toes, and I think the presence of the dog is sort of a gift to a writer as a metaphor for his point of view. And then as soon as we started talking, I realized all of these sort of ironies about my own life and him and the dog. My most recent novel, The Vegan, is about an exchange of empathy between a dog and a hedge fund manager, and the fact that his dog.
You'd already written this interaction.
Sorry?
You'd kind of already written this narrative before you met Green in an odd way.
Exactly. Yeah. And, that his dogs had perhaps attacked deer specifically. I actually don't say this in the piece, but when in me and my wife's early courtship days, she said if I was to be one animal, it would be a deer. And I didn't even realize this until I read a review of the book in the Times, but the protagonist of my book, his name could translate to deer killer. And there were just all of these coincidences that were just almost like overwhelming to me, that I just sort of felt everything. I want to use the word kismet, but that sort of implies too much luck and happiness. There was something doomsday about the entire interaction where I felt like the color saturation of my entire world shifted after talking to him, because, like many doomsayers, their job is to sort of open your eyes, whether
Cassandra's.
Cassandra's, exactly. Though
my wife's called Cassandra, Andrew, so I don't know what that suggests about me.
You mean her name is Cassandra?
Yeah.
Well, I think what's funny about Cassandras, I think they are by definition correct. I'm looking this up. Nobody believes them, but they're correct. And I think whenever you read a media article, a finance article about a doomsayer, sometimes the opposite is true. They get so much attention and they're wrong. And I think whether Michael Green is a Cassandra or the more common model of someone who everyone believes what is wrong is to be decided. But
that's the old argument about, the clock always being right twice a day. You don't, interestingly enough, Green stars in the first part of the piece. A very interesting character. We'll have to get him on the show. Does he do interviews, by the way?
I don't know how he has time to do other things in his life.
Yeah, we'll have to see. Try and get him on. If he's watching, Michael, you're more than welcome. But you end with a dog psychologist, the wisdom of a dog psychologist, which seems to suggest that for you, the people who are best suited to understand the marketplace are dog psychologists. Tell us about Peter Jam.
Yeah, well, I finished by talking to Peter Jam and a Danish economist, prestigious Danish economist. So I did want to sort of, as I say in the piece, widen my aperture. But yeah, Peter Jam is someone who Michael and I ran into at the cafe we went to, so his dogs could get used to me. And I left the cafe finding Peter and Michael talking. Peter was basically lecturing Michael. It was surprising to see someone like Michael being lectured to about dog psychology. And just Peter is an extremely unique individual. And as I was writing the piece, I just had this urge to speak to him and present the ideas that I was dealing with to him to see what he thought. And he's sort of someone who doesn't believe in the investing market. He, as he told me, and as I write in the piece, sort of guitars are his market. And it was sort of refreshing to hear that and think of the guitar market as both totally the opposite of what index funds are and what passive investors do, and sort of similar, because what he ended up telling me is that he believes in the guitar market because in the past he's bought them and fixed them and sold them. So he knows that will happen again. And to me, that is perhaps the fundamental, perhaps flaw, perhaps guiding light of passive investors, is that they believe past performance does indicate future results. It's commonly said that the definition of insanity is doing something over and over and expecting different results. I think for something like passive investors, the definition of insanity is doing the same thing over and over and betting your life savings that it will continue to happen. every piece of financial literature has the same asterisk at the bottom, which says past performance does not guarantee future results. And I think that's something that's important to keep in mind.
So finally, Andrew, the $15 trillion question: what should people do then? I mean, you've noted in the piece that index funds aren't quite as secure as we'd like to think. What should people do who are heavily into these things? Should they buy guitars? Should they diversify? Should they put their money under the bed? Should they buy gold?
Yeah, it's great that you use the D word, diversify, because I think that's what people think they're already doing by passive investing. But I think that is the solution. Investing all your money in a slightly diverse range of public companies is not truly diversifying. Diversifying is putting some of your money in the market. Maybe it's a lot of your money, but also investing in property, always investing in things the value of, and even hedging. Michael Green does this through his funds, and it's something that a lot of active managers do. And it's actually the reason why they often underperform the market in whole, is that if the market does crash, by creating some sort of hedge, you would be okay in the end. And you sacrifice, usually some people say 5% or 10% of your money by investing in that hedge. What that would mean is you'll never do as well as the market. You'll always be lagging by 5 or 10%, assuming nothing changes. But if something does change, you'll be better equipped than anyone.